Hi everyone, it's Sid from Fundamental Research, and our guest today is Phil Cloutier, the CEO of Cartier Resource, a gold junior with 7 gold projects in the Abitibi mining district in Quebec. Agnico Eagle owns 16% of Cartier and is the largest shareholder. The area they operate in has seen multiple M&A in recent years, wherein juniors were acquired by majors. So the agenda for today is I'll kick off the call with our thoughts on gold, and Phil will take over from there and talk to us about Cartier, upcoming plans, and how he attracted Agnico. For listeners, you can either wait till the end to ask questions, or if you have questions during the presentation, feel free to type them in and we'll try to respond to them. Here are some key disclaimers. Please take a moment. So let's talk about gold. As shown in this chart, even though gold hit $1,900 an ounce last week, gold and silver have outperformed or underperformed base metals in the past 12 months. We have 5 reasons to believe that gold will perform well over the next 6 months. I'll take you through one by one. First point, gold's value proposition is higher when interest rates are low. We believe rate hikes will be slower than expected, as the last thing the Fed will want is to raise rates too quickly and dampen this economic recovery. Note that China is already experiencing a weakness, and the US and the GDP growth in the US is expected to be weaker this year relative to last year. So we feel the Fed will be very cautious before they start raising rates too soon. As shown here, the US has negative real rates, and rates are expected to stay negative for at least another 6 months. We believe it will take multiple rate hikes for yields to catch up to historical levels. My next point is high inflation. Inflation in the US is currently at a 40-year high. We believe that inflation is unlikely to be transitory, as US money supply, US M2 money supply, is up 35% since the beginning of the pandemic. Prior to the pandemic, M2 had increased at just 6% per annum in the previous 2 decades. As shown here, money supply and gold prices are positively correlated. Another key point to note is that rate hikes were not able to curb inflation when the Fed raised rates during 2016 to 2019. Gold was up 16% during that period. The third factor for gold is rising production cost. Notice the quarter-over-quarter increase every quarter since Q4 2020. My fourth point is rising cash inflows into gold ETF. Note the jump in January. You can see the cash inflows have significantly increased this year. My fifth point is that historically, gold prices tend to increase when there's correction in equity markets, especially when tech stocks fall. As equity markets are trading at record highs and well above pre-pandemic levels, we are expecting a correction in equity valuations as the key economic metrics are still below pre-pandemic levels. Those were my 5 points. With that, I would like to welcome Phil, the CEO of Cartier Resource. Phil, you'll be able to share your screen. Please go ahead when you're ready.
Yes. Thank you. Can you see my screen?
Perfect, Phil. Thanks.
Very well. So typically what we do is we're an explorer, gold explorer, and we focus on the Quebec portion of the Abitibi Greenstone Belt. I want to highlight here that the Abitibi Greenstone Belt has a horde of qualified workforce and access to tremendous infrastructure. We have projects, namely in 2 areas. One, our flagship along the Cadillac Fault Zone, that needs no introduction, and then 3 other projects with historical resources on them, and one with a maiden resource estimate in the emerging Windfall district. And you could see where the mills are and where some projects that are in the news with our competitors. I'm going to start the presentation by presenting 4 slides that summarize what we're doing on our flagship Chimo Mine project, where PA is in progress. And then I'm just going to give you a short introduction to one of the pipeline projects that we're working on, the Fenton Gold Project. If you were to fly over the Chimo mine project right now, well, this is what you would see. Historically, this is a past gold producer. You can see the restored tailings, the sand pit, the mill area, the pond settling, and a 25 kilovolt power line that comes within 300 meters of the shaft. What we've done in the past 3 years is drilled over 124 diamond drill holes over a 32-month period, just under 60,000 meters of diamond drilling in 3 phases, and produced 3 resource estimates. This slide shows you the underground infrastructure at the past producing Chimo mine. You can see that there was actually 3 historical developers at Chimo gold mines during the mid-60s. They were producing half an ounce material in the upper levels here. Then Luvem in the mid-80s, discovered some new lenses to the south of that, zones 3, 4, and 5, and mined 105,000 ounces. And then Cambior bought the project for $8 million, essentially an exploration project. And when they bought the project, well, they couldn't, they had to sink the shaft down to 920, do some exploration. They discovered a new zone down here and subsequently mined and extracted about 200,000 ounces of gold. So all said and done, just under 400,000 ounces of gold, 2.4 million tons at just under 5 grams per ton. After our work program, well, this is what you have. On the left-hand side of the screen, the previous slide, just for scale, and on the right-hand side of the screen, at the same scale as on the left, you can see the massive expansion that we've done with the 60,000 meters of diamond drilling. We delineated just over 2 million ounces in the indicated and inferred category. All of that is within 500 meters of the underground infrastructure. And what you see here is when we filed the 3rd resource estimate in March 2021, we had initiated and had expanded on internal engineering studies. And by the end of 2021, that was well into progress, and we were getting positive results. And that's why we decided to launch a PEA. You can see here the stope design, and you can even see some of the underground infrastructure that we have designed. The project has a lot of potential to expand laterally and obviously at depth. The second project I would like to talk about is Fenton. It differs quite massively from Chimo, but it has the similar characteristics. It's along a major fault zone, and recently we went back into the field and did some field work. I'd like to recall that in 2021, we acquired 100% of this project, whereas before we were 50-50 with SOCREM of the government. Here is a screenshot of the historical geophysics, essentially mag and some EM conductors, where you can see that the gold are associated with that coincident signature of mag and EM. The main known zone, the Fenton deposit, outcrops dead center in the project and can be found over 1.5 kilometers to the northwest and 1.5 kilometers to the southeast. Of other interest is a showing that has barely been drill tested that returned 356 grams per ton gold over under a meter and 42.3 grams per ton gold over 5 meters in diamond drilling. The next slide is a focus of all of the twin channel sampling that we did at the surface of the Fenton deposit. The Fenton deposit actually outcrops over a 325 meter strike length, and bobs and weaves and is about 15 to 25 meters wide. And you could read the grades off the slide here. They're quite interesting, half an ounce material over 1 to 2 to 3 meters. But of greater interest is these broad 1 ounce per ton intervals over widths of about 8 or 4 meters. This is what it looks like when it's trenched at surface. What I want to get back to, just before giving back the mic to Sid, is basically, that is what attracted Agnico in 2016. We acquired these projects via our unique strategy between 2012 and 2015. And by then, I believe, a senior company like Agnico were impressed by our acquisition signature, and they, placed the bet on us, and they acquired 19.9% stake via a $4.5 million financing. That obviously attracted a lot of interest by, the markets and other suitors. We then raised a lot of money and got to work and delivered basically on the Chima Mine project, where we continued to de-risk and advance it. And obviously, most recently, you've seen that Agnico has merged with Kirkland Lake. So, we'll see in the next months and years, what happens on the M&A front in the Abitibi. But I believe that Cartier, with the type of work it does and its strategy, is well positioned to take advantage of that situation. Sid?
Thank you so much, Phil, for the insight. We can now open to the call to a Q&A. Listeners, if you have any questions, please feel free to type them in, or you can click on the raise hand option and I can unmute you. So, Phil, while we wait for questions, I just want to also inform our audience here is that we initiated coverage on Cartier in December of last year. We did that to see our valuation. I encourage all of you to go check our platform, research frc.com, and search for the company named Cartier Resource. You can see our initial report, which has a third-party perspective on the story, and also our valuation. Just something quick on the valuation. We did a comparables valuation. We looked at a number of juniors operating in Canada, and we found that Cartier is trading at just $17 an ounce. So its EV to resource is $17 versus the sector average of $65 an ounce. So in terms of comparables valuation, Cartier is trading well below its peers. So one of the questions we always get, Phil, is how do juniors attract majors, which you already mentioned? Maybe you can I just want to try to pick your brain here. What do majors look for, these days when looking at, juniors? And any tips to our audience on what type of juniors they should be looking at?
Yeah, well, that's a very good question. And here are my thoughts. I once worked for a senior mining company. And in the early 90s, well, the senior mining companies started to do less and less exploration. And there was a good reason for that. The junior market was picking up on that. And the seniors said, hey, we'll let them raise the money, let them take the risk, and them make the discoveries. And then we'll get interested once they've come up with the discovery. I think flash forward to 2022, what seniors are looking at are juniors that can actually de-risk a project and delineate ounces in good districts that have quality workforce, that have proximity to infrastructure, that are good jurisdictions on the ESG front, and also juniors that not only will do good sound technical work, but are going to be at the forefront of all the CSR and ESG requirements. Because if a junior does its job, delineates a project that can demonstrate the economic parameters that will bring it to production, and that has been a good corporate citizen, then that favors M&A. If not, the senior will have to look at the project, accept that it's going to have to remediate the delinquent behavior of a junior, and possibly buy the project anyways, but at a discount. So I think the seniors are looking for projects that have, economic viability in districts that have a qualified workforce, good infrastructure, and a good, proactive fiscal and mining acceptance.
Appreciate it. That's very helpful, Phil. So I know you're working on a PEA on your flagship asset. Now, do you think majors will start looking at projects in PEA stage, or you need to be much more advanced, maybe feasibility or pre-feasibility, before someone takes a more serious look?
That's a good question. I think every company that is a gold producer has different metrics and different filters. Some start looking at a project from the very beginning, the very first drill holes. Other companies will look at a project only when there is a X amount of ounces in the mineral resource estimate. And then yet again, some will say, well, listen, just take it to the PEA stage and possibly even the pre-feasibility, and then we'll come in and finish the work. So it depends on the company's appetite. We'll look at the recent merger with Agnico and Kirkland Lake. No doubt their metrics for what they look at has changed. Their bar has probably risen a bit, and that's created a vacuum for some intermediate companies out there or junior producers that are probably going to say, well, look, here's an opportunity. I can be more aggressive, and I won't be fought off by a bigger suitor. The key to this, to rewarding our shareholders as a junior, is to always be relevant, especially relevant here in 2022, and be ready to answer to those offers that may be on the table at any given moment. As I mentioned before, I think in another interview, when you see a junior sell its assets at a discount, it's either because it doesn't understand the value of its asset or because it's running out of cash. I believe Cartier understands the full value of its asset, and we do have a good safety cushion with $6 million in the bank, and we're in a safe jurisdiction. So I think we're definitely an investment opportunity with the low EV per ounce that you mentioned previously in the interview.
Got it. I recently heard from Barrick CEO that they are now looking to pay premium for their targets, and he mentioned that historically has been quite skeptical about paying premiums, but now in this market he is looking at paying premiums. So that's a good news for all juniors out there. But talking about PEA, I have a bunch of questions here, mainly regarding its progress and timelines.
Yeah, well, the progress, the last production meeting that we had, everything was online. They were doing the inquests into the metallurgy. They were doing the material handling sequence stuff. So everything seemed to be online. Well, I really can't control when this report will be out. I do know that we've requested, because of the nature and where this project is located, for them to do an exhaustive review of as many scenarios as possible. For example, building a mill on site, and that'll generate, economic metrics, and or using toll milling. As you can see on this slide right up on the screen here, there's no less than 5 or 6 mills. So, and that generates different NPVs and different IRRs. And then you have, you do some forward-looking thinking here. And then you have the government saying, well, look, we're going to encourage projects that are mostly underground, that could have a net zero carbon footprint. And that's easy to do, or more easy to do in Quebec. And also projects will tend to fast track projects where you can avoid building a new environmental scar. So this project definitely has a lot of optionality and advantages to it. And we want to make sure that we're running through the checklist as much as possible. So I believe it's the PEA is in progress, but I can't give you a date.
Sometime this year?
Oh yeah.
Okay, very good.
Unless something dramatic changes at Cartier that would require us to say, well, hey, this thing can keep growing. That's the timeline.
Okay, but I also have to mention to everyone that there's a sector-wide delay in everything. All the geologists and third parties have a huge pipeline. So
part of the inflation.
Yeah. And
well, the inflation, Sid, is not only on materials, right?
Yeah.
Inflation, and then because of COVID, is also hit hard on the various independent consulting firms and services firms. And it could be auditors to legal counsel and especially consulting firms that do PEAs and mineral resource estimates, or even supervising drill programs. There's a severe shortage of that type of talent in our industry right now.
Are you able to give us an idea how much has costs gone up by, in general, exploration cost in Quebec in the maybe last 2-3 years?
Yes and no. The yes part is most projects close to infrastructure, bulky, very bulky drill programs, 100,000 meters or more. Surprisingly, you're still able to get in the 100 to 125, 150, let's say, all in per meter, and that's impressive. But then again, a lot of the projects that are being drilled right now, some of them such as I guess Windfall or Wallbridge, or the O'Brien project at Radisson, ours at Chimo, the type of drilling where we have directional drilling involved in very deep targets, technically complex stuff, that would be more north of $250 to $300 per meter if you're lucky, and then you've got your supervision and building the team. So it's not a clear-cut answer whether you're doing a more standard shallow drilling approach versus a more complex deep diamond drill program that requires directional diamond drilling.
Sector-wide, our research indicates about a 20% increase, 30% in few cases over the last.
That would be about right, and I think even more. If you slap into the picture that some of the hotels are shut down, and so some of the companies have to build camps in the bush. Assaying is delayed and extra costs. Some people go pay extra. Yeah, it's an easy 20 to 30% inflation.
One of the things I wanted to touch upon here is Phil mentioned about PEA and different scenarios. One of the key advantages of this company, Cartier, is so many options are there for toll milling. For our listeners, if you're not familiar with this term, it's basically Cartier as an option, assuming they have an agreement with one of these facilities, is Cartier will have an option to send or truck its materials to one of these facilities instead of building their own processing facility on site. And that is a huge savings in terms of initial capex. And the economics is totally different. OPEX tends to be higher because you now have to send it to a different facility and they will charge you. But the economics normally looks better when you can do toll milling. And the second benefit of this is you can go into production sooner because you don't have the construction period. We have a few more questions there, but I'll just go one by one. One question I've been 2 or 3 questions similar is, why do you think Cartier is trading well below its peers? I think it's the PEA could be a catalyst. So the market will understand the true economics behind this, because right now there's uncertainty in terms of which is better. Is it toll milling or is it building on site? I think once market sees more concrete numbers, they'll have more confidence. Phil, do you want to add anything?
Well, you're right. I mean, once you anchor numbers in somebody's mind, they're able to see right away, okay, this is worth this much. Why is it trading way below? Here's my investment opportunity. That's one factor. Second factor is because, listen, we've marketed our stuff for 3 to 4 to 5 years now, and granted, there's investor fatigue and impatience. Some investors want to see this turned around rather quickly, and here we are, just hitting the nail on the head and getting our project to where we think it's going to be. And as I mentioned, it can keep growing. So we're careful with wanting to anchor a number in people's mind that we already know is going to be stale dated by the time the report comes out. That's my only comment. Okay.
A lot of discussion from majors. I don't know how true it is internally for them, is about ESG. A few years ago, people used to call ESG just a fad, but now it seems it's definitely become mainstream. A lot of majors have started talking or explicitly mentioning how important ESG is for them, which means it's trickled down. Now, juniors are also looking at, positioning themselves, with regards to ESG. What can you tell about your initiatives? Any comments you can add there, Phil?
Yeah, listen, as far back as 2011, we were awarded the E3 Plus award by the equivalent of PDAC here in Quebec, the AEMQ, which is Environmental Excellence in Exploration. So we've been working on this for over a decade. More recently, for instance, we've signed 2 mineral exploration agreements with the Cree First Nations of Waswanipi, one for Benoit and one for Fenton. ESG is very important because in a remote area like the Abitibi, it's grown on the local communities and First Nations that they want to be involved. They want part of the economic benefits. And one of the biggest costs in starting up a mine is the fly-in, fly-out components and the culture clashes with different or people coming in. So I think it's all to the advantage of exploration companies and mining companies to do a good job on the environmental and social governance issues. It just makes it so much better getting your project into operation in a timely fashion. It's more than lip service for sure. And it has to be done. And I'm very happy our industry is there, and especially, I can't speak with other jurisdictions, but for Quebec, I think we're ahead of the curve here, and it's all to our credit.
Okay. Another point that always stood out for us for Cartier is always the balance sheet is strong, especially now that you're sitting on a lot of cash. How long will it last? Will most of that funds be going towards the main asset, or what are your plans really?
Well, right now in the short term, we obviously advancing the PEA, and in early year we're working on Fenton. We have about 3 million-ish in flow through and another 3 point something 5 in hard cash. So we're well funded. If nothing changes, we're well funded for the next 2 or 3 years. Obviously, if we're going to break away and do a massive exploration program on Chimo and Fenton, we'd be on the lookout for additional funding. But that would mean that our stock price would be much, much higher, and investors want to partake in that adventure. But for now, we're extremely well funded for the next 2 or 3 years.
That is a good segue for the next question is, are you taking baby steps, or because we also see other juniors take all the cash and just go full out and do an aggressive exploration everywhere, right? So yeah, is that a better approach? Obviously, you chose the latter, which is go slow. How do you differentiate these two strategies, and what are your thoughts?
Okay, well, that's a very good point. I think if you take baby steps because you're fearful and you don't have a clear map going forward, or you don't have the technical team to do the work, and you don't, then that's one thing. But if you take baby steps because you're constantly monitoring the best opportunity and the best route forward, then that's a different thing. I mean, right now we have to keep a close eye on where the PEA is going to suggest we should be going. And we're keeping a close eye on additional opportunities to keep expanding our resource base and our project base. And we've just recently received the geophysics on Fenton and completed the juxtaposition of the geological, the structural, the mineralization, and the geophysical signatures. And we've engineered a very robust diamond drill program. So we're able to fire on all cylinders on different plays And that's one of the reasons right now we're taking baby steps, but I think that's going to change in the next month.
Makes sense. It seems like you are the second largest shareholder after Agnico, or maybe one of the largest. So definitely your interests are aligned with the investors. I see you have 5 million plus shares. Is that
Yeah,
fairly?
5.1 million shares. You're right. I've been buying our company shares when I'm able to do so over the past 15 years. Financially, I've invested, I think, close to $1 million in the company. I'm a strong believer in what we do. And I think the best way forward is to make sure that the senior management is aligned with in the investors' interests.
Okay. There are a few questions on your non-core assets, but I'll just summarize it for you. Are we still waiting for results on Benoit? Is your main focus going to be on Fenton and Chimo?
Well, the main focus is going to be on Chimo and then obviously Fenton moving forward. We have a joint venture, well, not a joint venture. We've optioned the project, the Wilson project, to a partner called Hot Moon Resources. I think today they've announced that they've gone all out for the permitting for the next phase of drilling. We've optioned our Delier project that's not on this map, but that's off to east of the Monster Lake project to Delta Resources, and that's the Delier project. Benoit, we drilled last year. We did a 17,000 meter diamond drill program, produced a maiden resource estimate. We've intersected mineralization and alteration in all of the holes beneath the deposit, but the grades weren't there. So we're looking at wounds right now on that one. It still has a lot of potential because we only focused on, essentially the deposit. There's about 100 other, geophysical targets out there. We're thinking what we're going to do next with that. And then we have other projects that aren't shown here on the map because they're more of the grassroots level, and we keep seeking partners to joint venture those out.
You have a follow-up question from your comment on baby steps changing next month. You're like, why would it change next month specifically?
Well, because then we make a decision if we start drilling on Fenton, and then we meet with the consultants on, how the PEA is shaping out. And then we've got announcements to make on either or, and then make a decision where we're going to go and where we're going to commit. And then, since the middle of last year, we were also monitoring. We have a project generation or project evaluation approach throughout the Abitibi. We've spotted some things that we like, and it's not because we're well advanced and focused on Chimo and Fenton and our other projects that we have to let great opportunities pass us by. So that's my answer to your question.
Okay, just one more question. Are there any other well-known investors other than Agnico, yourself?
Well, there's Ruffer out of the UK. There's Jupiter Asset Management. They initially were Old Mutual Global that were taken over by Mirion Global, and that became a much bigger firm. And then eventually, I think a year and a half ago, it became Jupiter Asset Management, a huge investment firm. So they're still there. So I have to check up on other European investors as well. Then there's our core long-term retail investors in Montreal and Val d'Or here. And then there's the Quebec sovereign funds, the Caisse de dépôt and the Fonds Solidarité. So, we have 218 million shares. I think more than 60 or 70% of that, we know where the shareholders are. So it's all in all, it's not that big of a float.
Perfect, Phil. I don't see any more questions. Any closing thoughts?
Listen, if anybody has any specific questions, they could always contact me, or obviously monitor fundamental research, because whatever we produce in terms of news releases, you will relay to your investor base as well. So anytime they want to talk to me, they just pick up the phone or toss me an email, and I'm at the other end and I'll answer if I can.
Appreciate it. Thank you so much, Phil, and everyone on the call for taking time today. A recording will be uploaded on our YouTube channel shortly. Please ensure you subscribe to our YouTube channel and also sign up to be a member of our platform, researchfrc.com. You'll get alerts when we publish new reports. And of course, you'll be able to see our list of top picks. Thanks again, and wish you all the best and stay safe.
Thank you very much, Sid.